Okay, let's unpack this. If you're someone who keeps an eye on the market, you know there are a few stocks out there that generate as much passion and just raw debate as Palantir Technologies, ticker's PLTR.
Oh, absolutely.
It's been a massive runner, but like a lot of these high-growth names, it just saw a pretty significant pullback.
It did, and that's what we're here for.
The stock's trading, as of the report, at about $177.
Which is roughly 15% off its 52-week high. And our mission today is to figure out why this report frames that dip, which smells a lot like panic to most investors, as the golden opportunity you missed.
Right. What's the core argument? What's the foundation for that kind of conviction?
That's the tension, isn't it? The market sees the price drop and immediately thinks high valuation risk, maybe a correction is starting.
But this analysis, it suggests the professional money, the big players, are seeing something completely different.
Something the rest of us are missing, that they're looking past the noise and focusing on the underlying financial and contractual realities.
What's really fascinating to me is that the report doesn't try to hide from the volatility. It leans right into it.
It does. It frings it immediately. Fear versus fact. The price action makes retail investors flinch, maybe sell at a loss.
While this entire bull case is built on that classic idea of buying the dip, the belief that the data shows this is just a consolidation, a pause before the next big move up.
Exactly. So we're going to try and look past the PE ratio panic and really focus on what the contracts and, the hypergrowth figures are actually saying.
So let's start with the most immediate thing, the data point that's causing all the pain right now, the dip itself.
Precisely. Let's ground this in the numbers for you. As of the close on January 9th, PLTR was sitting at $177.49.
So we're down about 15% from those recent highs, which were up near $207.
And a 15% drop will spook anyone. It makes you question everything.
But the report says this decline stopped. It stopped dead at a very, very specific level. And here's where it gets really interesting.
It really does. The analysis points to the $170 to $175 range.
And it calls it a massive floor.
A massive floor. Think of it like a line in the sand where the sentiment just flips from fear to demand.
And this isn't just a theory, right? We have immediate proof of this floor holding.
We do. If you look at the price action on January 9th, the intraday low hit $174.75. Just for a moment.
And then it just immediately, decisively bounced back. It closed several dollars higher.
That instant reversal, that's the signal. It tells you there is powerful, persistent buying pressure right there in that zone.
It's not a slow trickle of buying.
Yeah.
It's like a wall that just absorbs all the selling.
It is. So who is doing the buying? Who's catching the knife that retail investors are, throwing?
The report has a name for it.
It does. That bounce is cited as clear evidence of institutional accumulation. And this is a really crucial concept for you to grasp.
The big money.
The big money, pension funds, hedge funds, you name it, they are stepping in, quietly buying up shares when the retail crowd sells because of short-term fear.
So they see that 170 to 175 zone as the entry point, the last chance before the run-up into earnings.
That's the argument. It's a picture of strategic, patient money just exploiting the emotional reaction of smaller traders. Panic selling meets calculated buying.
Okay, so that brings us to the elephant in the room, the thing that's actually driving all this panic in the first place.
The valuation. We absolutely have to talk about the valuation. You can't discuss the bull case without hitting the central bear argument head on.
And the bears, they have a point, don't they? Wall Street analysts are always hammering the stock's astronomical price-to-earnings ratio.
The PE. And right now it stands at about 415 times earnings.
Which, to a traditional value investor, just sounds insane.
It is insane if you're only using traditional metrics. A PE of 415 means investors are willing to pay $415 for every $1 of the company's current earnings.
The argument is that it's priced for perfection.
Exactly. Any little hiccup, any sign of slowing growth, and the whole thing could come crashing down. That's the fear.
So this is where the bull case needs an ironclad rebuttal. And the report offers one with a really great analogy.
It's a brilliant analogy because it totally reframes the conversation. The analysis says, you don't value a rocket ship based on its fuel economy.
You value it based on where it's going.
Exactly. It makes the abstract ratio relatable. Judging PLTR on its current PE is like judging a revolutionary new technology on its gas mileage. You're missing the entire point, the destination.
That's the key to the whole argument then, shifting from current metrics to future potential.
But to back up that claim, to call it a rocket ship, you need evidence. You need to show hypergrowth that justifies paying that multiple today.
And what's a specific number they use? The one that makes that 415 PE start to look, well, Less insane.
U.S. commercial revenue growth.
Okay.
In the third quarter of 2025, that metric didn't just grow, it accelerated. It hit a staggering 121% year-over-year growth.
Just think about that. That's not just growth. That's triple-digit acceleration in what is probably the most valuable and scalable part of their entire business.
Correct. And when growth is accelerating past 100%, your traditional valuation models they can't keep up. They break. It suggests that today's earnings are an almost irrelevant footnote compared to what they could be in a few years.
And this kind of high multiple, it's not without precedent, is it? The report draws some specific comparisons.
It does, directly to the early days of Amazon and Tesla. Both of them traded at what people called insane multiples for years and years.
And why was that?
Because they weren't being valued on last quarter's earnings. They were being valued on the moat they were building.
The infrastructure?
Precisely. For years, people complained about Amazon's low profits while Bezos was building out this massive global network. Warehouses, logistics, and eventually AWS. The value wasn't in the books they sold in 1999.
It was in the fact that they were building the operating system for global retail.
And later for the internet itself. So if you apply that same logic to Palantir, they aren't just selling software.
They're building the foundational infrastructure for modern warfare, for government operations, for enterprise AI.
That is the core thesis. The vision in this report is that Palantir is building the AI operating system for the Western world. And if that's true, if they actually pull that off, then paying a 415 PE today is just the entry price.
Which transitions us perfectly. We've looked at the current pain, now let's focus on that future potential. If you, the listener, are buying into this story, the big question is, why now? Why is January 2026 the critical moment?
Well, you've got near-term catalysts, and then you've got the huge strategic drivers for the rest of the year.
Let's start with the closest one.
That would be the Q4 and full year 2025 earnings report.
Which is expected in mid-February, so about 30 days away. That's a tight window.
It is. And the analysis points to a very clear pattern. History suggests PLTR stock tends to run up significantly into earnings as anticipation builds.
So the argument is that this discount window might be closing fast.
Very fast. But beyond that short-term pop, let's talk about what makes 2026, as they call it, the year of deployment.
What's the big shift?
It starts with the enormous defense contracts. The report really emphasizes the financial impact of the massive Titan and Mission Command renewals.
This is the $10 billion Army contract secured in 2025, right?
That's the one. $10 billion, an astronomical guaranteed revenue stream. But the key detail the report highlights is the timing.
So it was secured last year, but when does the money actually start showing up?
Exactly. With these huge government contracts, there's a lag, the award happens, then implementation, deployment, and that guaranteed revenue is expected to start hitting the books starting heavily in 2026.
So it transforms the story from speculative potential into contractual certainty, backed by the U.S. government. The market has discounted the stock based on current earnings.
While ignoring revenue that is already contractually guaranteed to show up very, very soon.
And the commercial side is doing something similar.
Just as powerfully. Through their main conversion tool, what they call the AIP engine.
Okay, let's pause. Define that for us. What is the AIP engine?
AIP is their artificial intelligence platform. The engine is just their method for getting clients. They run these intensive short-term AIP boot camps, hands-on workshops.
And the report says the conversion rate on those is incredibly high.
Off the charts. They get clients hooked, prove the value in days, not months, and then lock in these long-term contracts.
So that success is what reinforces the whole year of deployment idea.
Yes. The groundwork is done. The sales force is scaled. Now, in 2026, it all translates into a massive recognizable revenue on the top line, which will, naturally cause that PE ratio to shrink on its own.
And we should probably loop back to that $170 floor we talked about, because there's another structural element supporting it.
The S&P 500 effect. Yes. This is a nuance a lot of people miss.
So now that PLTR is in the S&P 500 index,
massive amounts of passive investment, think ETFs and index funds, are required to hold the stock. They don't have a choice.
They have to buy it just to maintain their weighting in the index.
Correct. And that phenomenon effectively locks up the float, meaning fewer shares are available for daily trading.
So when the float is locked up, it makes the dips shallower. There's this constant mandated buying pressure underneath.
A structural safety net. It reinforces the idea that the dip is temporary, not an existential crisis.
And finally, let's just touch on the company's actual financial stability. The bear case often paints it like some speculative startup burning cash.
Which couldn't be further from the truth. The report calls it a financial fortress. They cite an estimated $6 billion or more in cash on hand.
Combined with a really crucial detail.
0 debt.
A cash-rich, debt-free operation. That's a huge safety net.
And maybe most important of all, the report confirms Palantir is GAAP profitable.
So it's not speculative anymore.
Not at all. It's cited as a cash printing machine that just happens to be growing like a startup. That profitability completely de-risks the investment against the volatility.
So what does this all mean? Let's bring it all together.
The conclusion from this analysis is, it's crystal clear. Investors who are worried just about the PE ratio today are missing the forest for the trees.
They're ignoring that 121% growth in the U.S. commercial business.
And they're ignoring the impending contractually guaranteed revenue from those massive defense contracts that start hitting the books this year in 2026.
So the ultimate prediction is that this whole dip down to 177 is just institutional accumulation.
And that anything under $180 is viewed as a steal before the next move up, with targets mentioned well into the 220 range.
The report frames Palantir as cementing itself as the NVIDIA of software in 2026.
It's a potent comparison, just like NVIDIA provides the hardware, the core engine for AI.
Palantir, the argument goes, is providing the software, the core operating system for AI deployment in government and enterprise.
It is a truly provocative comparison. And as we wrap up this deep dive, it raises a really important question for you, the learner, to think about.
The analysis points out that people missed the huge move from $20 to 170 because they were so focused on that high PE ratio.
They were judging it by old school rules. So the question is this. When you're analyzing a company that claims to be building the core AI operating system for the future, how much weight should you really place on historical valuation metrics?
Is hypergrowth a metric that just inherently defies traditional logic?
Or does the logic just need a time machine? It's that tension between the financial past and the technological future that really defines this entire investment thesis, and it's something you have to continue to explore.